Hey guys, let me start with a question that might sound crazy but is actually happening. If the US dollar is no longer the dollar, and the Chinese yuan is no longer the yuan, where should you put your money? Don't laugh just yet. Check this out. US national debt just smashed through $37 trillion, growing faster than ever in history. Next year, interest payments on US debt alone will hit $1 trillion. That's more than healthcare and defense spending combined. On the other side of the world, China's urban investment bonds are lining up for maturity. The total interest-bearing debt of China's urban investment platforms exceeds 60 trillion yuan. In 2025 alone, about 3.69 trillion yuan of these bonds are due. Throw in buybacks, and we're looking at nearly 4.96 trillion yuan. Meanwhile, revenue from land sales, a major cash cow, has dropped by 30%. If these two time bombs go off, how much of your hard-earned assets will be left? Right now, we're watching the trailer of a global financial tsunami called global asset revaluation, and you and I are standing right on the edge of the wave. Hey everyone, I'm Luna, here to break down macro trends into real numbers for your wallet. Today, I'm not here to lecture. Let's talk about 3 tough questions. Why is the dollar hegemony not just shaking, but really crumbling? How big is China's urban investment debt risk, and how can ordinary people protect themselves? Most importantly, as global assets lose value, what should we convert our money into to avoid getting fleeced or even come out on top? Let's start with the US dollar. First, we gotta be real. The dollar's dominance isn't failing overnight. It's that the holes are too big to patch. You might hear US debt being glorified as risk-free. But the truth is, U.S. national debt has hit historic highs and is unsustainable. The Peterson Foundation pointed out that if you spread the debt across U.S. households, each family owes $280,000 every person, $108,000. Economists at Goldman Sachs warn that if the U.S. doesn't act soon, unprecedented fiscal tightening may be needed to avoid crisis. So, has the U.S. government taken any real action to tackle the deficit? Of course. Why do you think Trump was swinging the tariff sword at global trade partners? This year, they even established a Department of Government Efficiency, shut down USAID, and pushed the Stablecoin Act partly to ease pressure from U.S. debt. And it's not like there's no legal limit to U.S. debt. Under U.S. law, government financing needs congressional approval. The Second Liberty Bond Act of 1917 set a debt ceiling, meaning the Treasury can't issue new debt once that limit is hit. So why is the debt hole still getting deeper? First, America's debt crisis is a side effect of election politics. In a two-party system, debt becomes a weapon. During elections, both Democrats and Republicans attack each other over the national debt. But once in power, they keep pushing policies that increase spending. Whether it's Democrats expanding welfare or Republicans cutting taxes, it's all about stimulating the economy to win votes and keep interest groups happy. Compared to the long-term risk of soaring debt, the election 3 years from now is clearly more important to both parties. Look at what happened under Biden. We had a $1.9 trillion economic relief bill, a $1.7 trillion federal spending bill, and a $1.2 trillion government funding bill, all huge spending packages. In 2025, although the Trump administration took measures like creating the Department of Government Efficiency and shutting down USAID to cut spending, the Big and Beautiful Act signed in July included around $4.5 trillion in tax cuts and raised the debt ceiling by another $5 trillion. Let's be real, the Big and Beautiful Act is really the Big and Ugly Act. With more borrowing allowed, tax cuts eating into revenue, interest payments shooting up, and the fiscal gap widening. The Trump administration tried to boost income by raising tariffs, but let's just say it didn't really work. Second, another reason for the surge in U.S. debt is the long-term high level of U.S. government spending. Over the past decade, the U.S. government's annual total spending has always stayed above $5 trillion. Since it first broke through $7 trillion in 2020, that number hasn't fallen below $6 trillion. On the spending side, 3 mandatory items, Social Security, Medicare, and interest on national debt now make up 73% of total fiscal spending in 2024. skyrocketing from 34% back in 1965, that massively shrinks the government's flexibility to adjust discretionary spending. For example, since 2020, spending by Health and Human Services has been the highest and keeps rising, reaching nearly $2 trillion in 2024 alone. Social Security Administration spending has stayed between $1 trillion and $1.5 trillion annually over the past 5 years. Then, from 2022 to 2024, affected by the Ukraine crisis and the Israel-Palestine conflict, U.S. foreign aid reached about $70 billion per year, almost $20 billion more than in 2021. So far, U.S. government spending in 2025 is already close to $6 trillion, and there's no sign of it slowing down. Making matters worse, since June 2022, the Fed started raising interest rates to fight inflation, pushing up U.S. debt interest costs. According to U.S. government data, as of July 2025, interest payments alone exceeded $1 trillion, making up 17% of total federal spending this fiscal year. Facing debt and deficit pressure, Trump turned his fire toward the Fed. So now the tug-of-war over rate cuts between the government and the Fed seems almost inevitable. The U.S. government, crushed by ultra-high debt interest, desperately needs relief. And if the government tightens its grip on the Fed might face fewer obstacles buying U.S. debt, making it easier for the government to fund itself directly through the Fed. After Powell's dovish comments, expectations for a September rate cut rose, but at the same time, the Fed's independence is weakening, and dollar hegemony is taking another hit. We talked about this before. Check out my earlier video if you're interested. So, the debt keeps growing. You might ask, what about the second Liberty Bond Act we mentioned earlier? Well, the debt ceiling is pretty much useless. To avoid a default and a major crisis of confidence, every time U.S. debt approaches the ceiling, they just raise or suspend it. Take recent years. In 2021, the debt ceiling was raised to $31.40 trillion. In January 2023, when debt exceeded that, Congress passed the Fiscal Responsibility Act, suspending the ceiling until January 1, 2025. On January 2, 2025, they adjusted it to around $36.1 trillion. If you keep moving the goalpost, you'll never hit the limits, like playing budget limbo. If you don't hear the alarm, there's no danger. At the same time, the labor market is showing signs of cooling off. In July, non-farm payrolls added only 73,000 jobs, far below the expected 100,000. Numbers for May and June were revised down by a combined 258,000 jobs. The unemployment rate rose to 4.2%. After the weak report, Trump quickly fired the Commissioner of Labor Statistics, raising doubts about the credibility of official data and fueling fears of stagflation in the U.S. But scarier still is the crisis of confidence in the U.S. dollar. Remember the 2008 financial crisis? The U.S. printed money like crazy to save the economy, and the dollar still held up. Why? Because of the petrodollar system, everyone needed dollars to buy oil. But now, Saudi Arabia sells oil to China in yuan. Russia accepts rupees or yuan for natural gas. Even India uses its own currency to buy coal, and the U.S. is making things worse. Trump's big and beautiful act will add $2.5 trillion in spending over the next decade. Nobel winner Paul Krugman straight up called it robbing the poor to feed the rich, low income. Families lose $1,600 a year, while the richest gain $12,000. I mean, can a currency really stay strong when the country survives by borrowing new debt to pay off the old? People used to see the dollar as a safe haven, but now China, Japan, Ireland, and Switzerland are all dumping U.S. debt. The Reserve Bank of India is reducing dollar reserves, buying gold and yuan instead. You might say the dollar is still the world's #1 currency. But guess what? In May, Moody's downgraded U.S. sovereign credit. That's the third major agency to do it after Fitch, and S&P. Trust in the dollar is fading bit by bit. The only card the U.S. has left is the dollar's special status. Once the market starts doubting that U.S. debt isn't an asset, it's a time bomb, now let's turn to China. How much debt does China actually have? Let's do a quick, rough calculation. So far, national debt outstanding is 35.6 trillion yuan, Local government debt stands at 50.5 trillion yuan. As for hidden local government debt, official figures reported 14.3 trillion yuan at the end of 2023. But market estimates put total urban investment debt at around 60 trillion yuan, taking into account the 10 trillion yuan debt resolution plan launched in 2024. The current hidden debt likely falls between 14.3 and 60 trillion yuan, though official sources lean toward 14.3 trillion debt. So, without hidden debt, total government debt is conservatively estimated at 86.1 trillion yuan, or 63.8% of GDP-IF. We include hidden debt. It's roughly 100.4 trillion yuan, about 74.4% of GDP. The biggest headache here is urban investment debt. Don't be intimidated by the term. It's basically bonds issued by local governments to build subways, parks, and industrial zones. Over the past decade, these bonds ballooned because everyone believed the government won't default. That's why they're now at a crossroads. On one hand, they're still a crucial funding source for local governments. On the other hand, hidden debt risks hang over them like a sword of Damocles. This year is different. 4.96 trillion yuan is due, but land sales revenue is down 30%. What does that mean? Local governments either need to sell land or issue new bonds. But what's the property market like now? Developers are afraid to buy land. Auction failure rates are at record highs. New bonds aren't easy to issue either. You might say, so what? They can just extend maturities by time. But once extensions start, credit collapses like dominoes. And behind urban investment debt are banks, insurers, wealth management products, ordinary people's savings and policies. In other words, this isn't just a local government problem, it's an earthquake on every individual's balance. When credit collapses, no one is innocent. What's more, China's fiscal deficit is also rising this year. The deficit to GDP ratio broke 4%, a record high. The government says it's to stimulate domestic demand. But it's crucial how this money is actually used, if it flows into inefficient areas or is wasted. The risks from urban investment debt will only grow. These bonds once drove urbanization, but now interest-bearing debt far exceeds local government bonds. Non-standard defaults are increasing. If risks explode, local economies and financial stability will definitely take a hit. You might be thinking, I don't hold dollars or urban investment debt. This doesn't affect me. You couldn't be more wrong. If the dollar depreciates, imported milk powder, cosmetics, and cars will get more expensive. If urban investment debt fails, local governments will tighten spending, jobs and infrastructure will suffer. If global assets depreciate, can your stocks and funds really stay immune? Think back to the 2008 subprime crisis. Lots of people thought it wasn't their problem. Then housing prices crashed, jobs disappeared, and everyone realized a financial storm is closer than it seems. There's another trend you gotta watch. De-dollarization is accelerating. India uses local currency to buy Russian oil. Brazil uses yuan in trade with China. The EU is pushing a euro. Behind this is a battle for currency influence, and stablecoins, they're basically extensions of fiat currency status. The more people use them, the stronger that currency's pricing power and the more reserve demand it gets. We might not join the currency war directly, but we can watch opportunities linked to de-dollarization, like companies in cross-border yuan payment systems or gold ETFs. There might be chances there. Let's be clear. Stablecoins aren't just a game of USDT or USDC tokens. They're breaking down central bank power into programmable code. The logic is simple. The dollar's credibility is shaking. People need a new anchor. Yuan. Internationalization has bottlenecks. It needs new channels. Government debt is exploding. It needs new buyers. So stablecoins emerge. Backed by U.S. debt on one hand and offering 24/7 global payments with almost no fees on the other. Even crazier, Hong Kong is using its 1 trillion yuan offshore pool as a sandbox, first launching dollar stablecoins to build trust, then yuan. This bypasses capital controls and brings new buyers for yuan assets. In a word, stablecoins aren't crypto, they're offshore central banking for the digital age. Some people ask, aren't stablecoins pegged to the dollar? If the dollar falls, don't they fall too? Here's where you're wrong. Stablecoins are asset proxies, not dollar proxies. You give $1. They issue one USD/TND. That $1 is held in reserves like cash or US debt. So in theory, one USDT always equals $1, but it doesn't carry US debt risk. Even better, stablecoins are starting to depeg from the dollar. Hong Kong's stablecoin ordinance effective August this year allows reserves in HKD or offshore yuan. The EU legislated for euro stablecoins last year. They want less dollar dependence. Why is JD.com rushing into Hong Kong's stablecoin sandbox? Why is Alibaba getting licenses in Singapore and Luxembourg? Not to speculate on crypto, but to enable cross-border payments, lower fees, faster transfers, smoother operations. How can that not be tempting? If more companies go this route, won't the dollar's role in cross-border payments slowly get eaten away? How can stablecoins hedge risk? Let's take 3 scenarios. First, you hold HKD and worry about dollar depreciation. Swap HKD for USDC. Deposit it in a DeFi protocol, earning 8% APY interest while avoiding exchange risk. Second, you hold yuan and fear urban investment debt defaults. Swap yuan for a yuan-pegged stablecoin like CNHC, then lend it to market makers, earn fees while dodging credit risk. Third, you only have a salary. On payday, convert 10% into a gold-backed stablecoin like Pax Gold long-term to hedge inflation. If gold rises, you profit. If it falls, you still earn interest. But let's be clear, stablecoins aren't safes. When FTX blew up in 2022, its linked stablecoins crashed. USDT has been questioned over insufficient reserves, scaring people into USDC. So choosing stablecoins comes down to compliance. USDC publishes monthly reserve reports. Hong Kong requires 100% equality asset backing and proper licensing. Those unlicensed, non-transparent fake stablecoins from small platforms. Their landmines don't even go near them. And I have to check a reality. Dollar hegemony won't collapse overnight. Not all urban investment debt will explode global. Asset depreciation won't happen tomorrow. The dollar is still the world's top payment currency. US military and tech power remains. The Chinese government is working on debt restructuring and injecting assets to manage risks. Global asset revaluation is a slow burn, an overnight crash. So stay alert, but don't panic or blindly follow trends. Last but not least, here's my heartfelt message. Financial markets never lack storms, but they lack people who can navigate them. In 2008, some preserved wealth by buying gold. In 2020, some profited from Bitcoin. This time, it might be about understanding the ties between the dollar, urban investment debt, and asset depreciation to protect your savings. But remember, opportunities favor the prepared, not the impulsive. Think about it. 10 years ago, who thought mobile payments would replace cash? 5 years ago, who believed governments would embrace digital currency? Now, de-dollarization is accelerating. Urban investment debt risks are surfacing, and global assets are being repriced. If you still think this doesn't affect me, by the time you react, your money might be worth half. But if you jump in blindly without assessing risk, you could lose even more than holding cash. This video isn't telling you to buy gold or dump all your assets. It's about facing reality. The dollar isn't eternally strong, urban investment debt isn't default proof, and global asset depreciation isn't just fear. What matters is understanding the logic and knowing the risks. Crisis isn't just the end of risk, can also be the starting point of wealth. When dollar hegemony collapses, no one is innocent, but anyone can learn to ride the wave. Finally, I want to ask you, if the dollar really falls, or urban investment debt really fails, what would you convert your money into? Or do you have a better idea? Let me know in the comments. Let's discuss how to navigate this financial storm with fewer detours and safer wallets. I'm Luna, here to translate macro trends into numbers you can use. Don't forget to like and follow. Next time I spot new trends, you'll hear it here first. See you in the next video.